Before we dive in, please remember that I am not a financial advisor, a mortgage lender, or a real estate agent. This presentation is for informational and educational purposes only. The housing market is complex and varies significantly by location. You should always consult with qualified professionals, like a licensed mortgage originator and a certified financial planner, to understand your specific situation and make the best decision for you and your family. You're scrolling through Zillow again. It's late. Everyone else is asleep, but you're on the hunt. You're swiping through pictures of renovated kitchens, dreaming of where you'd put the couch, imagining your kids or your dog running in the backyard. And then you find it. The one. It's not a mansion, but it's perfect. It has that extra room you could use as an office, it's in a good school district, it's got that charm you've been looking for. Your heart beats a little faster. This could be it. Then your eyes drift down to the price. $400,000. And your brain almost automatically does the math you've been trained to do your entire life. The math your parents taught you, the math every article seems to scream at you. 20%. The down payment. You pull out your phone's calculator just to confirm the soul-crushing number. $80,000 in cash. And just like that, the dream evaporates. The excitement you felt just seconds ago turns into that familiar, sinking feeling of frustration. $80,000. Who just has that sitting around? It feels like a finish line that moves further away every time you take a step. You close the app, roll over, and try to forget about it. But what if I told you that entire calculation, that entire dream-killing number, is the single biggest myth in American real estate? What if I told you that the 20% down payment is a ghost? A relic of a bygone era that has absolutely no bearing on whether you can or cannot buy a home today. In this video, I am going to pull back the curtain on the home buying process and show you the proven government-backed and completely legitimate strategies that thousands of Americans are using right now to buy a home with little, or in many cases, absolutely zero money down. We are going to talk about specific loan programs like VA loans and USDA loans that require a literal $0 down payment. We're going to break down how FHA loans can get you in the door for as little as 3.5%. And most importantly, we're going to uncover the world of down payment assistance programs, or DPAs, the so-called secret money, that can cover your entire down payment and even your closing costs. By the end of this video, you will have a clear, actionable roadmap. You will no longer look at a home price and feel defeated. Instead, you'll see a number and understand the multiple pathways you have to turn that listing into your reality, without needing a massive pile of cash in the bank. Now, I know what some of you are thinking. Zero down? This sounds like a scam. Sounds too good to be true. What's the catch? And you are smart to be skeptical. The truth is, there are catches. There are requirements. There are credit score minimums, income limits, and property location rules. This isn't a magic wand, but it is a set of tools. And the reason most people don't know about these tools is because the 20% down myth is so deeply embedded in our culture. Think about it. Who told you that you needed 20% down? Probably your parents or your grandparents. And they weren't lying to you. For their generation, in their economy, that was often the standard. It was the safe, responsible thing to do. Banks loved it because it meant the borrower had significant skin in the game, making them less of a risk. But the financial world has changed dramatically since then. The economy, housing prices, and lending practices are completely different. The government recognized that the 20% barrier was locking millions of creditworthy, responsible people out of homeownership, the cornerstone of building wealth in America. So, they created programs to solve this exact problem. The myth also persists because, frankly, it's just simpler. It's easier for people to repeat a simple rule of thumb than it is to explain the nuances of a USDA rural development loan. But that simple rule is costing you the opportunity to build equity and escape the rent trap. Every month you pay rent, you are paying someone else's mortgage. That money is gone forever. When you pay a mortgage, a portion of that payment is going back into your own pocket in the form of home equity. You are paying yourself. The difference is life-changing. Let me tell you a quick story about someone we'll call Sarah. Sarah is a 32-year-old registered nurse from a suburb outside of Austin, Texas. She makes a good salary, about $75,000 a year. She has a solid credit score, around 720. She pays her bills on time, has a stable job history, and is the exact type of person you'd think would be a homeowner. But she wasn't. For 5 years, she was stuck in an apartment, paying $1,600 a month in rent. Why? The down payment. After paying her rent, her car payment, her student loans, and just living, she was only able to save a few $100s a month. The home prices in her area were exploding. A starter home that was $300,000 2 years ago was now $400,000. The 20% down payment she thought she needed went from $60,000 to $80,000. It was impossible. She felt like she was on a treadmill, running as fast as she could, but the wall just kept getting further away. She was convinced she'd be renting for another decade. Sarah's not a unique case. She represents millions of Americans, teachers, firefighters, technicians, young professionals, who are doing everything right but are still locked out of the market because of this one single outdated myth. They have the income to afford the monthly mortgage payment, which is often the same or even less than their rent, but they don't have the lump sum for the down payment. Then one day, a coworker who had just bought a house mentioned something about a USDA loan. Sarah had never heard of it. She assumed it was for farmers, but her coworker explained that it was a government loan for homes in designated suburban and rural areas, and the down payment was zero. Her suburb, just 30 minutes outside of downtown Austin, qualified. Suddenly a light went on. Sarah started digging. She discovered a world she never knew existed. She learned about FHA loans. She learned about down payment assistance grants in Texas that didn't have to be paid back. The $80,000 wall she had been staring at for years began to crumble. It wasn't one single thing. It was the realization that there were multiple ways to climb it, go around it, or even tunnel under it. 3 months later, Sarah closed on her first home. A 3-bedroom, 2-bath house with a small yard for a dog she planned to adopt. Her down payment? Zero. Her closing costs were covered by a state assistance program. Her monthly mortgage payment, including taxes and insurance, was $1,750. Just $150 more than the rent she was throwing away on her tiny apartment. Sarah's story isn't a one-in-a-million lottery win. It's a roadmap. And over the next few minutes, I'm going to hand you that exact map. We're not dealing in theory here. We are dealing in concrete, actionable strategies. We're going to start by breaking down the 2 most powerful zero down payment loans available in the United States. Programs that could get you into a house with literally not one single dollar out of your savings for a down payment. So grab a notebook and let's dismantle this myth piece by piece. First up, let's talk about the undisputed heavyweight champion of zero down home loans. This isn't some obscure loophole or a temporary grant program. This is a benefit, earned through service and sacrifice, and it's arguably the most powerful mortgage product in the entire country. I'm talking about the VA loan. Guaranteed by the U.S. Department of Veterans Affairs, this loan is available to active duty service members, veterans, and in some cases surviving spouses. And its primary, most celebrated feature is the ability to buy a home with 0.0% down. Now let that sink in for a moment. The median home price in the United States is hovering around $400,000. A traditional 20% down payment on that home would be $80,000. Even a low down payment FHA loan at 3.5% would require you to show up with $14,000 in cash. That's a massive barrier. It's the reason millions of people are stuck renting, paying their landlord's mortgage instead of their own. But with a VA loan on that same $400,000 house, the down payment required can be zero. Not a single penny from your savings account needs to go towards the down payment. While everyone else is scrambling for tens of thousands of dollars, eligible veterans and service members can step right into the game. This isn't just a financial product, it's a promise kept. It's the nation saying thank you for your service. Now let us help you build a life for yourself and your family. But here's the thing, and this is where the true power of the VA loan starts to reveal itself. The zero down feature is just the headline. It's the shiny object that gets all the attention. The real magic, the stuff that saves you a fortune over the life of your loan, is hidden in the fine print. And the biggest secret superpower of the VA loan is the complete and total absence of something called PMI. PMI stands for Private Mortgage Insurance. And it's the bane of most homebuyers who put down less than 20%. Here's how it works. When you make a small down payment, the lender sees you as a bigger risk. If you stop making payments, they stand to lose more money. So, to protect themselves, they force you to pay for an insurance policy that protects them. It's like being forced to buy your boss a birthday present. You pay the bill, but you get none of the benefit. This isn't a small fee. PMI can easily cost you anywhere from $100 to $300, or even more, every single month. That's thousands of dollars a year, flushed away on an insurance policy that does nothing for you. It's just gone. VA loans do not have PMI. ever. It doesn't matter if you put down 0% or 10%. There is no monthly mortgage insurance fee. By eliminating PMI, a VA loan effectively gives you a permanent pay raise the day you move into your home. That $200 a month you're not paying in PMI can go towards your utilities, your car payment, your kids' college fund, or better yet, straight towards your principal, allowing you to pay off your house years faster. This single benefit is a financial game changer that most people completely overlook. But wait, it gets better. Superpower number 2. Incredibly competitive interest rates. Because the VA guarantees a portion of the loan, lenders see it as a much safer bet. Less risk for them almost always translates to a lower interest rate for you. Even 0.25% or 0.5% difference in your interest rate might not sound like much, but over a 30-year mortgage, it can save you tens of thousands of dollars in interest payments. So not only do you get in with no money down and no monthly PMI, but you also get a better deal on the loan itself. Now I know what you're thinking. This sounds way too good to be true. There has to be a catch. What's the hidden fee? And you're right to be skeptical. There is a fee associated with most VA loans, and it's called the VA funding fee. But before you click away, understand how this works. The funding fee is a one-time charge that helps keep the loan program running for future generations of service members without costing the taxpayers. It's a percentage of the loan amount, and it varies depending on your service, your down payment amount, and whether it's your first time using the benefit. For most first-time users putting zero down, it's typically 2.3% of the loan amount. Aha! You say, there's the catch. I still have to pay thousands of dollars. But here is the most crucial detail about the funding fee. In most cases, you can roll it directly into your total loan balance. This means it doesn't have to be paid in cash at closing. It just becomes part of your monthly mortgage payment, spread out over 30 years. So while it is a cost, it's not an out-of-pocket expense that prevents you from buying the home. The spirit of zero down is preserved. And there's more good news. This fee is not for everyone. Veterans receiving VA disability compensation are typically exempt from paying the funding fee entirely. That's a massive savings, and another way the program supports those who have sacrificed the most. So how do you even know if you qualify? The key to unlocking the VA loan is a document called the Certificate of Eligibility, or COE. This is your golden ticket. It's the official document that proves to the lender that you meet the minimum service requirements. And getting it is way easier than you might think. You don't need to navigate some bureaucratic maze at the VA. In most cases, any VA-approved lender can pull your COE for you online in a matter of minutes. Let's put this all together with a quick story. Meet Sarah, an Air Force veteran who just finished her enlistment. She's got a good job, a little bit of savings, and a dream of buying a small townhouse so her dog can have a yard. She looks at house prices and does the math. She thinks she needs $40,000 for a down payment and closing costs. Feels impossible. It feels like she's a decade away from her dream. Then a friend tells her about the VA loan. She's skeptical, but she calls a lender who specializes in them. The lender pulls her certificate of eligibility in 5 minutes. They get her pre-approved for a $300,000 loan. She finds the perfect townhouse. At the closing table, she needs $0 for a down payment. The seller even agreed to pay some of her closing costs. Another unique feature of VA loans. She has to pay the VA funding fee, but she rolls it into the loan. Her monthly payment is $300 less than a comparable conventional loan would have been, because she has a great interest rate and absolutely no PMI. Sarah walks out of that office with the keys to her first home. Her savings account still intact, wondering why nobody had ever explained this to her before. This story plays out every single day across America. But there are still so many myths. People think you can only use it once. False. It's a lifetime benefit you can use over and over. People think you need a perfect credit score. False. The VA guidelines are often more flexible than conventional loans. The VA loan is a testament to how we can and should support our service members. It is the most direct path to homeownership for those who have served. A true zero down payment option packed with wealth-building benefits. But what if you didn't serve in the military? What if you're a teacher, a firefighter, a nurse, or an office worker? Is the dream of buying a home with no down payment completely off the table for you? Absolutely not. In fact, the US government has another lesser-known powerhouse of a zero-down program that has nothing to do with military service. It's designed for people who want to live in specific areas. And you might be absolutely shocked to find out that your dream suburb, or that quiet little town you've been eyeing, is on the approved list. We're going to break that down next. The The program we're talking about is the USDA loan. And right now, I know what at least half of you are thinking. USDA. United States Department of Agriculture. You're picturing a farmhouse, a red barn, 100 acres of corn, and a tractor out front. You're thinking, that's great, but I'm a software developer, not a farmer. I want a 3-bedroom house in a good school district, not a silo. And if that's what you're thinking, you are making the single most common and most costly mistake people make when they hear about this program. Because the USDA loan is the government's best-kept secret for suburban home buyers. Let me tell you about Mark and Sarah. They're a fictional couple, but their story is real for millions of Americans. Mark is a high school history teacher and Sarah is a nurse. They've been married for 5 years, living in a cramped 2-bedroom apartment that costs them $1,700 a month. They do everything right. They have good credit, stable jobs, and they've been trying to save, but life keeps happening. A car repair, a student loan payment, the cost of groceries going up, you know how it is. They want to buy a house in a nice suburb just outside the city, a place with a little yard for a dog, a safe street for their future kids to ride bikes. The median home price there is about $350,000. They sat down with a calculator one night and did the math. A traditional 20% down payment was $70,000. An impossible number. So they looked at an FHA loan which required 3.5%. That's still over $12,000, and with closing costs they'd need closer to $20,000 cash. For them, that might as well have been $1 million. They felt trapped, like they were just lighting rent money on fire every month with no end in sight. Homeownership felt like a dream that was for a different generation, for people who got in before prices went insane. One day, a mortgage lender mentioned the USDA loan. Mark laughed. "We're not buying a farm," he said. The lender just smiled and said, "Go to their website. Check the property eligibility map. Just humor me." That night, feeling defeated but a little curious, Sarah pulled up the USDA map. She zoomed in on their metro area. The big city center was grayed out, ineligible, just as they expected. But then she started looking at the towns on the outskirts, the exact towns they had been dreaming about. She typed in the zip code for that suburb with the great schools, the one with the cute downtown and the community pool. She held her breath and clicked enter, and the screen lit up. The entire area was shaded. A little box popped up that said, "This address is in an eligible area." It was a lightning bolt moment. The single biggest obstacle standing between them and a home of their own, that massive pile of cash for a down payment, wasn't an obstacle anymore. The barrier was imaginary. They had disqualified themselves based on a name, on a misconception. For them, this one discovery changed everything. This is not a rare story. The USDA's definition of rural is probably not what you think it is. It's not about agriculture. It's mostly about population density. Generally, any town or city with a population of 35,000 or less qualifies. Think about that. How many incredible, vibrant, growing suburban towns are there in this country with populations under that number? Thousands. Tens of thousands. In fact, over 97% of the landmass of the United States is located in a USDA-eligible zone. Let me say that again. 97%. From the outskirts of Phoenix, Arizona to the suburbs of Raleigh, North Carolina. From the towns outside Tampa, Florida to the communities surrounding Denver, Colorado. You would be absolutely stunned to see how many places qualify. So what's the catch? There's always a catch, right? Well, with the USDA loan, it's less of a catch and more of a set of guardrails. The program is designed to help people who need it most, so there are 2 main requirements you have to meet, aside from the property being in an eligible area. First, there are income limits. But again, these are probably much more generous than you think. The program is for low to moderate income households. The key is that the definition of moderate income is tied to the median income of that specific county. So, the income limit for a family in a more expensive county in California is going to be way higher than the limit in a very rural, low-cost-of-living county in the Midwest. It's adjusted for the local economy. For a household of 1 to 4 people, the limit in many areas is around $100,000 a year, and in some higher-cost areas, it can exceed $150,000. The government isn't looking at your income in a vacuum. They're looking at it relative to the cost of living where you want to buy. The second requirement is your credit. The USDA itself doesn't set a hard minimum credit score, but the private lenders who actually issue these government-backed loans do. For most lenders, you're going to need a credit score of 640 or higher to get approved. This shows them that you have a history of paying your bills on time and are a reliable borrower. So, it's not for people with deeply troubled credit, but it is very accessible for the average American who has been responsible with their finances. Now, if you meet those conditions, the property is eligible, your income is within the limit, and your credit is solid, you unlock some incredible benefits. The biggest, of course, is 100% financing. 0 down payment. You can walk into a home of your own without having to spend a decade saving tens of thousands of dollars. But it gets even better. USDA loans often have some of the lowest fixed interest rates on the market, sometimes lower than conventional loans. And what about mortgage insurance? You know, that extra fee you have to pay on most loans when you put down less than 20%? On a conventional loan, it's called PMI. On an FHA loan, it's a mortgage insurance premium that lasts for the life of the loan in many cases. The USDA has its own version called a guarantee fee. It consists of an upfront fee that can often be rolled into the loan amount, and a small annual fee paid monthly. And here's the key. That monthly fee is almost always significantly cheaper than the mortgage insurance on an FHA or a conventional loan. So over the life of your 30-year mortgage, you're not just saving on the down payment, you're saving thousands, potentially tens of thousands, of dollars in interest and insurance costs. It is, without a doubt, one of the most powerful home buying tools in existence. It allows people like Mark and Sarah to escape the rent trap and start building equity, building a life, in a community they love. It transforms the dream of homeownership from a distant fantasy into an immediate, achievable reality. But it's not the only way. There is another, equally powerful zero down payment loan out there. This one isn't based on where you want to live, or even what your income is. It's based on who you are, and more specifically what you've done for your country. It is a thank you, a sacred promise turned into a home loan. And it is reserved for a very special group of Americans. I'm talking about our nation's military service members, our veterans, and in some cases, their surviving spouses. The program that makes this all possible is the VA Home Loan Guarantee Program. And it is, without a doubt, the most powerful home loan product in the United States. But to truly understand its power, you can't just look at the numbers on a spreadsheet. You have to understand its soul. You have to go back in time. The year is 1944. The world is at war. Millions of Americans are serving overseas, fighting in the fields of France, the islands of the Pacific. Back home, a nation holds its breath, but it also dares to dream of what comes next. What happens when these millions of young men and women come home? Where will they work? Where will they live? A group of visionaries, leaders of the American Legion, asked these questions and refused to accept a return to the breadlines of the Great Depression that followed the First World War. They drafted a bill, a revolutionary piece of legislation that would reshape the American landscape forever. It was called the Servicemen's Readjustment Act of 1944. We know it today as the GI Bill. It wasn't just a thank you card. It was a tangible investment in the future of the nation. It provided tuition for college, unemployment benefits, and most critically for our story, a guarantee for home loans. For the first time in history, a generation of working-class Americans was given a direct path to homeownership without the need for a massive, life-altering down payment. The GI Bill didn't just build houses, it built the suburbs. It built the middle class. It built the American dream as we know it. That promise, forged in the fires of World War II, is the very same promise that lives on today in the modern VA loan. It's a legacy, and if you are eligible, it is your birthright. So let's break down exactly what this promise means for you right now in today's market. The headline feature, the one that changes everything, is the 0% down payment. 100% financing. Let that sink in. The single biggest barrier to homeownership for most Americans is the down payment. Think about it. Saving up 20% or even 5% of a $300,000, $400,000, or $500,000 home can take years. It's a mountain that seems to grow taller every time you get closer to the peak. The VA loan flattens that mountain. It says to the 22-year-old Marine just finishing their first enlistment, you don't have to wait until you're 32 to buy a home. You can start building equity right now. It says to the Army veteran transitioning to civilian life, your service was your down payment. This isn't a subprime loan or a risky gimmick. This is a core feature of a prime loan, guaranteed by the United States government. But the magic doesn't stop there. In fact, the next benefit might be even more impactful over the long run. No private mortgage insurance. PMI. For those who don't know, PMI is a special kind of hell reserved for homebuyers who put down less than 20% on a conventional loan. It's an insurance policy that you, the borrower, are forced to pay for every single month. But it doesn't protect you. It protects the lender in case you default. It's a penalty for not having a huge pile of cash. And it can add hundreds of dollars to your monthly mortgage payment. $200, $300, $400 a month, just vanishing into thin air. Over 5 or 10 years, that's tens of thousands of dollars you could have used for investments for your kids' college fund for anything else. The VA loan completely eliminates PMI. Period. Because the loan is already guaranteed by the Department of Veterans Affairs, the lender doesn't need that extra insurance. This single feature makes a VA loan significantly cheaper, month to month, than a comparable FHA or conventional loan with a low down payment. And the benefits keep stacking up. The VA loan program generally has more lenient credit and income requirements compared to conventional loans. The government understands that military life is not a straight line. It involves deployments, frequent moves, and unpredictable transitions. Your financial life might not look like a neat little package, and the VA loan is designed to accommodate that reality. It looks at the whole picture of your financial stability, not just a 3-digit score. On top of that, the VA actually limits the closing costs that lenders can charge. They put a cap on what you can be asked to pay in fees for things like origination, appraisals, and processing. It's another layer of protection, another way the program is built from the ground up to serve the veteran, not just the bank. Now, I know what some of you are thinking. This sounds too good to be true. You've heard the myths. You've heard a real estate agent or a friend say, "Oh, sellers hate VA loans," or "They're a nightmare to close." Let's dismantle those myths right now because they are dangerously outdated. The first myth: VA loans are slow and full of red tape. Decades ago, this might have had a kernel of truth. But today, with a lender who is experienced in VA loans, the process is just as fast and streamlined as any other loan type. The key is working with a professional who understands the system, not someone who's only done 1 or 2 in their career. The second, more damaging myth: sellers won't accept an offer with a VA loan. This myth comes from old rules that are no longer in effect and a misunderstanding of the VA appraisal process. The VA appraisal is not there to sabotage the deal. It's there to protect the veteran. It ensures the home is safe, sound, and sanitary, and that you aren't overpaying for the property. It's a feature, not a bug. In a competitive market, a well-qualified buyer with a VA loan is an incredibly strong buyer. You have the full faith and credit of the U.S. government behind you. A great real estate agent knows how to communicate this strength to the seller, dispelling any outdated biases and highlighting that you are one of the most secure buyers they could possibly work with. And the biggest myth of all: you can only use it once. This is completely false. The VA loan benefit is a lifelong benefit that you can use over and over again. When you sell the home you bought with a VA loan and pay it off, your full entitlement is typically restored. You can then go and buy another home with a new VA loan, again with 0 down payment. You can even, in some cases, have more than one VA loan at a time. This transforms the VA loan from a one-time gift into a powerful tool for building wealth throughout your life, moving from a starter home to a forever home as your family and career grow. So what's the catch? There really isn't one, but there is a cost: the VA funding fee. This is a one-time fee paid to the Department of Veterans Affairs to help keep the program running for future generations of service members, ensuring it operates with no burden on U.S. taxpayers. The fee varies depending on your service, your down payment amount, and whether it's your first time using the benefit. It can be paid in cash at closing, or, as most people do, rolled into the total loan amount. And here's a crucial detail: this fee is often waived entirely for veterans receiving VA disability compensation and for surviving spouses of veterans who died in service or from a service-connected disability. It is a system designed with honor at its core. The VA loan is not a handout. It is an earned benefit. It is a nation's gratitude forged into a key, designed to unlock the very dream that so many have fought to defend. It is the single most effective 0 down payment option in existence. But it's not for everyone. By its very definition, its reach is limited to those who have served. So what about the other 93% of the country? What if you're a teacher, a firefighter, a first-time buyer just trying to get your foot in the door? Are you just stuck saving for a decade? Or is there another path? Another government program designed not for veterans, but for everyday Americans? There is. And it's one of the best-kept secrets in American real estate. It's a program that allows for 100% financing, 0 down payment, but it's not for veterans. It's for everyone else. It's called the USDA Rural Development Guaranteed Housing Loan. Now, I know what you're thinking. You just heard the letters USDA and the word rural, and your mind immediately went to a farm. You're picturing a red barn, a silo, maybe a few cows. You're thinking, that's great, but I don't want to live in the middle of a cornfield, 50 miles from the nearest Starbucks. And this right here is the single biggest misconception about this incredible program. It's the reason millions of eligible Americans never even look into it. They hear rural and they shut down. But the USDA's definition of rural is probably not what you think it is. It's not about agriculture. It's about population density. The goal of this program isn't to create more farmers. It's to encourage growth and development in communities outside of major metropolitan cores. What does that actually mean for you? It means that vast swaths of suburban America, the kind of towns with great schools, charming main streets, and a Target just 10 minutes away, are considered rural by the USDA. We're talking about thousands of towns and small cities all across the country. You could be 30 minutes from downtown Denver, 45 minutes from the heart of Atlanta, or just outside the city limits of Orlando, and be standing in a USDA-eligible area. This isn't a niche program for people who want to live off the grid. This is a mainstream program for teachers, nurses, software developers, mechanics, anyone who meets the criteria and wants to buy a home in one of these designated areas. It's designed to make homeownership accessible in the very places where communities are growing. So how does it work? Like the VA loan, it's not a direct loan from the government. The USDA doesn't give you the money. Instead, they provide a guarantee to private lenders, banks, and credit unions. They essentially tell the lender, hey, if you give this qualified buyer a mortgage with no down payment, we'll back a portion of that loan. We'll take on some of the risk. And for a lender, reduced risk is everything. It's what makes them comfortable enough to lend you hundreds of thousands of dollars without you putting a single dollar down. The result? 100% financing. If you're buying a home for $350,000, you can get a loan for $350,000. Your down payment is zero. This is a life-changing opportunity for people who have good credit and stable income, but just haven't been able to stockpile that massive pile of cash for a traditional down payment. Of course, it's not a free-for-all. There are two major requirements you have to meet, and this is where you need to pay close attention. First, the property itself. The home you want to buy must be located in a USDA-eligible area. This is non-negotiable, but finding out is incredibly easy. The USDA has an official eligibility map on their website. You can literally type in an address, and in 2 seconds the map will tell you if it qualifies. I highly recommend you pause this video later, Google USDA Property Eligibility Map, and just play around with it. Check the towns near you. I guarantee you will be shocked at how many suburbs and beautiful communities are eligible. You might discover your dream neighborhood qualifies. The second major requirement is you, the borrower. This program is specifically designed to help low to moderate income households. This means there are income limits. Unlike the VA loan, which has no income cap, the USDA program is targeted. Your household's total income cannot exceed the limit for that specific county. Now, don't let the phrase low to moderate income scare you off. These limits are often much higher than people assume, especially in more expensive areas and for larger households. For example, in some counties, a family of 4 could make over $100,000 a year and still qualify. The limits are adjusted based on the cost of living in each specific area. So, just like the property map, the USDA has an income eligibility tool on their website. You select your state and county, enter your household information, and it will tell you the exact income limit for your area. Again, it takes less than a minute and it provides a definitive answer. So, you have to meet the location requirement and the income requirement. If you clear those 2 hurdles, you're in the game. But let's be transparent. Is there a catch? What's the trade-off for getting a zero-down loan? With the USDA loan, the trade-off is mortgage insurance. Because the lender is taking on more risk with a 100% loan, the USDA requires 2 forms of it. First, there's an upfront guarantee fee. As of today, it's typically around 1% of the loan amount. So on a $300,000 loan, that's a $3,000 fee. But here's the crucial part. In most cases, you can roll this fee directly into your mortgage. So you're not paying it out of pocket at closing. Your loan amount just becomes $303,000 instead of $300,000. Second, there's an annual fee, which is paid in monthly installments as part of your mortgage payment. This is similar to the private mortgage insurance, or PMI, you'd pay on a conventional loan with less than 20% down. The percentage is very low, currently around 0.35% of the loan balance per year. It's a cost, absolutely, but it's the cost that unlocks the door to a zero down payment. For many people, paying an extra $100 or so a month is infinitely more achievable than saving $50,000 for a down payment. So let's go back to that teacher or that firefighter or that young family just starting out. They have good jobs, they pay their bills on time, but the idea of saving a 20%, 10%, or even a 5% down payment feels like a fantasy. They check the USDA map and find out the charming suburb they've been renting in for years is eligible. They check the income limits and discover their combined salary fits comfortably within the range. Suddenly, the entire conversation changes. The impossible dream becomes a concrete plan. The mountain of a down payment vanishes, and the only financial hurdle left is the closing costs, which, by the way, you can sometimes negotiate for the seller to help with or even receive gift funds for. This program single-handedly takes the biggest barrier to homeownership and removes it from the equation. It's a powerful tool, a pathway to building equity and generational wealth for everyday Americans who live and work outside the biggest city centers. It's the government's way of saying, we want our smaller towns and suburban communities to thrive, and we're going to help you put down roots here. But what if you look at the USDA map, and your dream neighborhood is a mile inside the ineligible zone? What if your income is just a few $1,000s over the limit? Or what if you're not a veteran, and you're determined to live in the heart of a major city? Are you back to square one, staring at that savings account feeling defeated? Not quite, because there's a third door. A hidden network of programs that can bring your down payment to zero, even on a conventional loan in any location. It's a world of assistance most people have no idea even exists, and it's where we're going next. This ecosystem of assistance is vast, an intricate web of over 2,500 different programs spread across every single state. They're run by state housing authorities, city governments, nonprofits, and even employers. And they all have one mission: to get you, a creditworthy buyer, over the single biggest hurdle to homeownership, the down payment. This isn't a single secret key. It's a whole ring of them. And the most powerful ones fall into three main categories. First, you have the Holy Grail, grants. This is free money. Let's be perfectly clear about that. It's a gift, a direct injection of cash into your home purchase that you never, ever have to pay back. Imagine you're buying a $300,000 home. A conventional loan might require a 3% down payment, which is $9,000. You find a state program that offers a 3% grant. Boom! The program wires the $9,000 to the closing table on your behalf. Your down payment is covered. It's done. You just bought a home with a zero down payment out of your own pocket. These aren't fantasy scenarios. They happen every single day. The money for these grants comes from things like state-issued bonds or specific real estate taxes, all designed to promote stable homeownership in the community. It's an investment in you and in the neighborhood. But grants are just the beginning. The second, and perhaps most common type of assistance, is the forgivable loan. This is where things get really interesting. Lenders sometimes call these silent seconds or soft seconds, and they are one of the most powerful wealth-building tools you've never heard of. Here's how it works. A housing agency gives you a loan for your down payment. Let's say it's $15,000. It's technically a second mortgage on your home, sitting right behind your main loan. But here's the magic. It requires no monthly payments. It accrues no interest. It just sits there silently, and it comes with a condition. Usually, that condition is that you have to live in the home as your primary residence for a set number of years, typically 5, maybe 7 or 10. If you meet that condition, if you just live in your house for 5 years, that entire $15,000 loan is forgiven. It vanishes. Poof. It's gone. It effectively becomes a grant that you earned with time. Think about it. The average person stays in their first home for about 7 to 10 years anyway. These programs are rewarding you for doing exactly what you were already planning to do. It's like a loyalty program for your own house. Every year you live there, a portion of that loan disappears until the balance is zero. This single tool has allowed millions of Americans, people with good jobs and good credit but no savings, to get into a home and start building equity years before they otherwise could have. Let's make this real. Meet Sarah and Tom. Sarah's a third-grade teacher, Tom's a paramedic. They make a combined $90,000 a year. Their credit is solid, a 740. They have a little bit saved, but life is expensive. Student loans, a car payment, rent that keeps going up. They want to buy a $400,000 house in their community, but the 5% down payment, $20,000, feels like a mountain they can't climb. They figure they'll have to save for another 4 years, all while home prices and interest rates keep rising, pushing their goal further and further away. They feel trapped. Then their loan officer tells them about the third door. They discover their state's housing finance agency offers a forgivable loan for up to 4% of the purchase price. On their $400,000 home, that's $16,000. It's a silent second, forgiven after 5 years. Suddenly, their $20,000 down payment is slashed to just $4,000. But it gets better. They keep digging. They find a local city program called Hometown Heroes that offers a $5,000 grant. Not a loan, a grant, to essential workers like teachers and paramedics. They apply for both. They get approved. Let's do the math. They needed $20,000 for their down payment. They get a $16,000 forgivable loan from the state. They get a $5,000 grant from the city. That's $21,000 in assistance. It covers their entire down payment and leaves them with an extra $1,000 to help with closing costs. They get a conventional loan, their private mortgage insurance is lower than it would be on an FHA loan, and they get the keys to their first home. That $16,000 loan will completely disappear after their kid's 5th birthday. Instead of waiting for more years, they started building equity today. Their story isn't an exception. It's the blueprint. This is how the system is designed to work. The third type of assistance is a repayable second mortgage. Now, this isn't free money like a grant or a forgivable loan, but it's the next best thing. A cheap, easy loan to cover your down payment so you can get in the game now. These loans typically have a very low fixed interest rate or sometimes a 0% interest rate. The payment terms are incredibly flexible. Some you pay back in small monthly installments over 10 or 15 years. Others, and this is a huge benefit, are deferred. That means you don't pay a single dime on it until you sell the house, refinance, or pay off your primary mortgage, whichever comes first. You're essentially borrowing your down payment from a helpful housing agency instead of a high-interest credit card or a 401k loan. It solves your immediate cash problem and lets you start benefiting from home appreciation right away. So you have grants, forgivable loans, and repayable loans. This is the arsenal. But I know what you're thinking. This sounds too good to be true. What's the catch? There isn't a catch, but there are conditions. And you need to know them. These programs aren't a free-for-all. They are targeted. The first condition is usually an income limit. But I want you to erase the image of this being only for very low-income families. Many of these programs are designed for the middle class, the teachers, firefighters, nurses, and office workers who make a decent living but struggle to save a lump sum. The income limits are based on the area median income, or AMI, of your specific county. And it's very common for these programs to serve households making up to 120% or even 140% of the AMI. In many parts of the country, that means a family making over $100,000 a year can still qualify. The second condition is often purchase price limits. You won't be able to use these programs to buy $1 million mansion. They are designed to promote affordable, sustainable homeownership. The third is that you typically have to be a first-time homebuyer. But the government's definition of first-time is incredibly generous. It usually means you just haven't owned a home in the last 3 years. So if you sold a house after a divorce or a job relocation 4 years ago, you're a first-time homebuyer again in the eyes of these programs. Finally, most programs will require you to take a homebuyer education course. Don't groan. This is one of the best parts. These are often online 8-hour courses that cost next to nothing, and they are a masterclass in homeownership. They teach you about budgeting, home maintenance, property taxes, and how to avoid foreclosure. It's free knowledge that makes you a smarter, more confident homeowner. The catch is that they're investing in making you successful. So yes, there are strings attached, but they are strings designed to pull you up, not hold you down. They ensure the assistance goes to the people it was meant for, buying the types of homes that build stable communities, and equipping them with the knowledge to succeed long-term. So now you know the secret arsenal exists. Grants, forgivable loans, a whole world of help. But knowing it exists and finding the exact program for you are two different things. It can feel like searching for a needle in a nationwide haystack. How do you find these hyper-local, state-specific, and profession-based programs? How do you know which ones you qualify for? Well, you don't need a treasure map. You just need to know where to look. And in the next part, I'm going to give you the exact websites, the exact resources, and the exact questions to ask to pinpoint the perfect DPA program for your situation. Alright, let's pull back the curtain. The first place you need to go isn't some secret forum or a dusty library. It's the U.S. Department of Housing and Urban Development, or HUD. Just go to hud.gov. This is the federal government's mothership for all things housing. On their site, you can find a state-by-state list of home buying programs, including down payment assistance. It's a bit like a government phone book. Not the prettiest, but it's official, it's comprehensive, and it's a fantastic starting point to see the landscape in your state. But if you want something a little more user-friendly, a little more 21st century, then you need to know about a website called Down Payment Resource. Think of it like Zillow but for down payment money. This platform is a massive database of DPA programs from all over the country. You can plug in some basic information about your situation like your location, your household income, and your profession, and it will spit out a list of programs you might be eligible for. It's an incredible tool that many real estate agents and lenders use behind the scenes, but you can access it directly. It turns a nationwide scavenger hunt into a 10-minute search. Now let's get more specific. While these national resources are great for a bird's-eye view, the real magic, the most generous programs, are often found at the state and local level. Every single state has what's called a Housing Finance Agency, or HFA. I want you to pause this video later and literally Google your state's name followed by Housing Finance Agency. California has CalHFA. Texas has the Texas Department of Housing and Community Affairs. Florida has the Florida Housing Finance Corporation. They all have different names, but their mission is the same: to help people in their state achieve homeownership. Their websites are treasure troves of information on DPA grants, forgivable loans, and special mortgage programs you won't find at your big national bank. And we can zoom in even further. Don't stop at the state level. Many larger cities and even counties have their own hyperlocal DPA programs. These are often funded by local budgets to encourage people to live and work in the community. You might find a program specifically for first responders in Phoenix, or for teachers in Chicago, or for first-time buyers in a specific revitalizing neighborhood in Baltimore. The search is as simple as Googling your city or county name plus down payment assistance. You will be shocked at what you find. Okay, so you've done your homework. You have a list of potential programs from HUD, from Down Payment Resource, from your state HFA, and maybe even your city. Now what? You have a list of names, but what do they actually mean? This is where you transform from a hopeful buyer into a savvy, empowered consumer. You need to become an investigator and you need to ask the right questions. Here is the exact list of questions you need to ask about every single DPA program you find. Question number 1, and it is the most important. Is this a grant or a loan? A grant is a gift. It's free money that you never have to pay back. They are the unicorns of down payment assistance, but they absolutely exist. A loan, on the other hand, is borrowed money that, in some way, shape, or form, has to be accounted for. Getting this first question answered separates the free money from the borrowed money. If the answer is it's a loan, your immediate follow-up is question number 2. Is the loan forgivable? This is the magic word. Forgivable. A forgivable loan is a type of second mortgage that you don't have to pay back, as long as you meet certain conditions. The most common condition is simply living in the home as your primary residence for a set period of time, usually 5, 7, or even 10 years. For every year you live there, a portion of the loan is forgiven. If you stay for the full term, the entire debt disappears into thin air. It's the closest thing to a grant you can get. This is how thousands of people get their down payment covered and never pay a dime of it back. But what if it's not forgivable? That leads to question number 3. What are the repayment terms? There are 2 main possibilities here. The first, and most common for DPA, is a deferred payment loan. This means you don't have to make any monthly payments on the DPA loan. It just sits there silently with no interest or a very low interest rate. The full amount only becomes due when you sell the house, refinance your main mortgage, or pay the house off completely, often 30 years down the line. It's like having a silent, friendly investor in your home. The other possibility is an amortizing loan, which means it works like a traditional loan. You'll have a second, smaller monthly payment on top of your main mortgage payment. This is less ideal, but if it's the only thing standing between you and a home, it can still be a powerful tool. Next, you need to ask about the eligibility rules. Question 4. What are the income limits? These programs are designed to help low to moderate income households, not millionaires. Every program has a maximum income threshold you cannot exceed. This limit is usually based on a percentage of the area median income, or AMI, for your county. The limits are often surprisingly high. especially in expensive areas, so never assume you make too much money. Always check the specific numbers for the program. Similarly, question 5 is, are there purchase price limits? Just as they limit your income, these programs also limit the price of the home you can buy. Again, this is to ensure the funds are going to help people buy modest starter homes, not luxury estates. Now for the practical stuff. Question 6. What are the credit score requirements? While many DPA programs are designed to be more accessible than conventional loans, you can't have a 450 credit score and expect to qualify. Most programs will look for a minimum credit score, often somewhere in the 620 to 640 range. This is a critical piece of information you need to know up front. Question 7. Is there a mandatory homebuyer education course? The answer is almost always yes, and you should be happy about it. These are not difficult, scary college courses. It's usually an online class that takes a few hours to complete. They are designed to make you a smarter, more successful homeowner, teaching you about budgeting, home maintenance, and the mortgage process. The certificate of completion is your golden ticket to qualify for the DPA money. Think of it as free coaching for the biggest purchase of your life. Finally, the pro-level question. Question number 8. Can this assistance be combined with other programs or seller concessions? This is called stacking. Can you use a state DPA program and a city DPA program? Can you get a DPA grant and also have the seller pay for your closing costs? Understanding the rules of stacking can be the difference between getting some help and getting almost your entire cash to close covered. So let's put it all together. Your action plan is simple. Start with the national and state websites to build a list of potential DPA programs in your area. Then take that list and for each program run down those 8 questions. Is it a grant or a loan? Is it forgivable? What are the repayment terms, the income limits, the purchase price limits, the credit score requirements? Is there a class? And can it be stacked? By the time you're done, you'll have a short list of 1 or 2 programs that are a perfect fit for you. And this brings us to the final crucial step. You can't just walk into any bank with this information. You need to work with a lender who is specifically approved to offer these programs. Not every loan officer knows how to handle a CalHFA loan or a local city grant. Trying to force a lender who isn't experienced with DPA to do one is like trying to teach a fish to ride a bicycle. It's a frustrating waste of time for everyone. The good news is, the same state and local HFA websites that list the programs almost always have a list of their approved certified lending partners. These are the loan officers who are experts in this world. They are the gatekeepers who can actually get you to the finish line. But finding a name on a list is one thing. Finding a true partner who will fight for you, who understands the nuances, and who can navigate the paperwork is another. How do you vet these lenders? How do you interview them to make sure they're the real deal and not just someone who took a one-day course? Because choosing the right lender is just as important as choosing the right house. And that is exactly what we are going to break down next. Alright, let's get down to brass tacks. You're about to have one of the most important conversations of your home buying journey. This isn't just a phone call, it's an interview. But here's the critical mindset shift you need to make right now. You are not the one being interviewed. They are. You are the CEO of your home search, and you are hiring for the position of Chief Financial Officer. They are applying for a job. They work for you, not the other way around. Too many buyers walk into this conversation feeling small, like they're asking for a favor. You're not. You are a highly sought-after client bringing a 6-figure deal to their table. They need your business more than you need any single one of them. So you're going to approach this with confidence, with a clipboard and a pen, ready to take notes. You're in charge. Your first rule of engagement is the 3-lender rule. Never ever ever talk to just one lender. That's like proposing to the first person you ever go on a date with. You need to shop around to understand what's out there. And you need to shop smart. I want you to talk to 3 specific types of lenders to get a full 360-degree view of the market. First, you're going to call a big national bank. Think Chase, Bank of America, Wells Fargo. The behemoths. The pros? If you already bank with them, they might offer relationship discounts. Their processes are often very streamlined and tech-forward. The cons? They can be rigid. They're like a giant cruise ship, powerful but they can't turn on a dime. They might not have deep expertise in specialized government loans like USDA or VA. And their loan officers are often just employees working a 9-to-5. Second, you're going to call a local credit union. These are nonprofit institutions owned by their members. The pros? They often have fantastic interest rates and lower fees because they're not beholden to shareholders. Their service is usually more personal. The cons: you typically have to become a member to get a loan, which might have certain eligibility requirements, and their product selection might be more limited than a big bank's. And third, you're going to call a mortgage broker. This is the secret weapon. A mortgage broker doesn't work for one single bank. They work for you. They're like a personal shopper for mortgages. They have relationships with dozens of different lenders, big banks, small banks, wholesale lenders you've never even heard of. And their job is to find the best possible loan program for your specific situation. They are often experts in niche products because finding the unfindable is how they make their living. This is where you'll often find the most expertise in zero down payment loans. Now, once you have your 3 candidates lined up, it's time for the interrogation. Here are the 5 killer questions you must ask every single one of them. Write these down. Question number 1, and this is the most important. How many USDA or VA loans, whichever one you're targeting, have you personally closed in the last 12 months? Listen carefully to the answer. You are testing for specific recent experience. This question immediately separates the specialists from the generalists. You do not want your zero-down loan, which has extra paperwork and specific government guidelines, to be a learning experience for your lender. A bad answer sounds like this. Oh yeah, we do those all the time. They're pretty straightforward. That's a dodge. A great answer sounds like this. That's my specialty. I've personally closed 17 USDA loans in the last year. We actually have a processor on our team who only handles government loans, so she knows exactly what the underwriters are looking for before we even submit the file. See the difference? Specificity is a sign of expertise. Question number 2. What is your communication process and what are your hours? If my real estate agent and I find the perfect house on a Saturday afternoon and need an updated pre-approval letter to make an offer, what does that process look like? The real estate market doesn't stop at 5 p.m. on a Friday. A lender who is unavailable on weekends can literally cost you your dream home. A bad answer. Well, our office is open Monday through Friday 9 to 5. You can submit a request through our online portal, and we'll get to it as soon as we can on Monday morning. By then the house is gone. A fantastic answer. You'll have my personal cell phone number. Text me. Call me. The market is a 24/7 battleground, and I'm your partner in it. I can typically get you a revised letter within 30 minutes, day or night. That's the person you want in your corner when things get competitive. Question number 3. Can you provide me with an official loan estimate, and will you walk me through every single number in section A and B, line by line? This question tests their transparency and their willingness to educate you. The loan estimate is a standardized 3-page document that breaks down the approximate costs of your loan. Some lenders will try to gloss over this, but the details are where they hide the junk fees. Section A is their lender fees, the money they make directly. Section B are services you cannot shop for. A bad answer. Don't worry about all that, it's just a bunch of standard fees. We have the best rates. That's a massive red flag. A great answer. Absolutely. Let's pull it up on screen share right now. Okay, see this line here, the origination fee? That's our charge for doing the loan. Everything else down here are estimated third-party costs, like the appraisal and title fees. I'll even show you which ones you can shop around for to save more money. That is a partner, not a salesman. Question number 4. After this initial pre-approval stage, who will be my primary point of contact? Will I continue working with you? Or will my file be handed off to someone else? This is the bait and switch question. Sometimes you'll talk to a smooth, experienced senior loan officer to get you in the door, and then the second you sign, you're handed off to a junior assistant who doesn't know anything. A bad answer. Once you have a property under contract, our processing team takes over. You'll get automated email updates from our system. This is how you fall through the cracks. A great answer. You'll be working with both me and my dedicated processor, Maria. I'm the strategist. I'll be negotiating your terms and advising you. Maria is the logistics expert. She'll help you gather documents and we'll keep you updated on deadlines. The 3 of us will have a kickoff call together, and I'll be on every single email, so I'm always in the loop and available to you. That's a professional team structure. And finally, question number 5. This one is my favorite because it forces them to tell you a story. Tell me about a time a zero-down loan for one of your clients almost fell apart, and what you did to save it. This is a behavioral interview question that reveals their real-world problem-solving skills. A bad answer is, oh, that never happens. Our files always go smoothly. That is either a lie or a sign of inexperience. Things always happen in real estate. An underwriter asks for a weird document. An appraisal comes in low. A last-minute credit issue pops up. A great answer sounds like a story. Oh man, I had one last month. A USDA loan. The appraiser noted a peeling paint chip on an outbuilding, and the underwriter was going to deny the loan. It was a Friday afternoon. I immediately got on a three-way call with the selling agent and the buyer's agent, arranged for a handyman to go out there Saturday morning, got a paid receipt and photos, and had it back to the underwriter by noon. We still closed on time. That's the person you want. Someone who has seen it all and knows how to navigate the chaos. Once you've interviewed your 3 candidates, you'll have 3 loan estimates. Don't just look at the interest rate. The interest rate is marketing. Look at the APR, the annual percentage rate. The APR includes the interest rate plus most of the lender fees, giving you a more accurate, apples-to-apples comparison of the true cost of each loan. Compare the lender fees in Section A. Is one lender charging you $1,000 more in processing or underwriting fees? That's pure profit for them. But the final decision isn't just about the numbers. It's about the person. Who did you connect with? Who made you feel empowered and educated, not confused and small? Who demonstrated the experience and the tenacity to fight for you? This is one of the biggest financial transactions of your life. You need a guide you can trust implicitly. Choosing your lender is a monumental step. It turns the dream of maybe I can buy a house into the reality of I am approved to buy a house. But getting that pre-approval letter is like getting the keys to the race car. You still need an expert driver who knows the track. And in this market, that driver is your real estate agent. But not just any agent. You need a very specific kind of agent, one who understands the nuances of zero-down financing, who knows how to structure offers that compete with cash, and who won't treat you like a second-class citizen just because you're not bringing 20% down. Finding that person is an art form, and it's completely different from finding a lender. So how do you find this mythical creature? This real estate agent who is part strategist, part therapist, and part financial wizard? You have to stop thinking like a homebuyer and start thinking like a CEO. You are hiring for the most important position in your personal finance company, the head of real estate acquisition. And you need to be ruthless in your interview process. Most people find their agent in one of 3 ways, and all of them are terrible. First, they click the Contact Agent button on Zillow or Redfin. You know what that does? It sends your information to whichever agent paid the most money for your zip code. You're not getting the best agent. You're getting the agent with the biggest marketing budget. It's like choosing a surgeon based on who has the flashiest billboard on the highway. It's a recipe for disaster. The second way is a referral from a friend or family member. This sounds safe, but it's often a trap. Your cousin Bob might have had a great experience with his agent, but did Bob buy a house with a zero-down VA loan? Or did he put 25% down on a conventional loan 10 years ago? The skills required for those 2 transactions are as different as a go-kart and a Formula One car. A great agent for a simple deal can be a catastrophic agent for a complex one. And the third way, people just go with the first person they talk to. They feel a sense of obligation, or they're just too nervous to shop around. This is insane. You're about to sign a contract that legally binds you to this person for months. A person who will be advising you on a $500,000 decision. You wouldn't marry the first person you went on a date with, so don't sign with the first agent who buys you a cup of coffee. You need a specialist. You wouldn't go to a foot doctor for brain surgery, and you shouldn't go to a luxury condo agent for a USDA loan. You need to find the agent who geeks out on this stuff. The one whose eyes light up when you mention down payment assistance, who knows the FHA appraisal guidelines by heart, and who has the personal cell phone number of 3 different loan officers who specialize in closing VA loans in under 30 days. So here's the playbook. You are going to interview a minimum of 3 real estate agents. Not email them, not text them. You are going to get them on the phone or a video call for a formal interview. And you are going to ask them a series of killer questions designed to expose the pretenders and reveal the true experts. Get a pen because you need to write these down. Question number 1. In the last 12 months, what percentage of your clients were first-time homebuyers, and how many of them used a government-backed loan like FHA, VA, or USDA? This is the ultimate filter question. A great agent for you will say something like, "Oh, that's my specialty. Probably 70 to 80% of my business is working with first-timers using those exact programs." The wrong agent will hesitate. They'll say, well, I work with all types of buyers. I did one FHA loan last year, I think. Next, you want the person who lives and breathes this world, not someone who is just visiting. Question number 2. Can you walk me through a specific recent deal where you successfully negotiated for the seller to pay for all of your buyer's closing costs? Listen carefully to their answer. A novice will give you a vague, textbook response. Oh, well, you just asked for it in the offer. An expert will tell you a story. Absolutely. Just last month, we were up against 3 other offers on a property in Oakwood. We were using a VA loan. I knew the sellers were an older couple looking for a smooth, predictable close. So instead of just asking for the $10,000 in costs, we offered them a 2-week rent back for free after closing, which gave them the flexibility they needed to move without stress. They took our offer even though it wasn't the highest because we solved a problem for them. We got the house, and my clients came to closing with just $500 out of pocket. You see the difference? One is an answer. The other is a strategy. Question number 3. What is your specific strategy for making a zero-down offer stand out and compete against cash or large down payment offers? This is where the rubber meets the road. If they say, "It's tough, cash is king," hang up the phone. They have already given up. A true specialist will start rattling off a list of tactics. They'll talk about building rapport with the listing agent before even submitting the offer. They'll mention getting you fully underwritten by the lender upfront, so you can offer with no financing contingency, making you almost as strong as cash. They'll talk about using an escalation clause, offering a shorter inspection period, or providing a personal letter from you to the seller. They see your zero-down loan not as a weakness, but as a challenge that requires a smarter game plan. And the final, most important question. If I choose to work with you, who are the top 2 lenders you would recommend for my situation, and why specifically them? This question does 2 things. First, it tests their network. They should have names ready instantly, not just Bank of America. They should say, "I work with Sarah at Guild Mortgage and Mike at Cross Country. Sarah is a genius with FHA 203K renovation loans, and Mike's team are absolute rock stars with the VA loan. They consistently close 2 weeks faster than anyone else I know." Second, it reveals whether they understand that the lender-agent relationship is a partnership. A great agent knows their success is directly tied to the performance of the lender. They have a vetted, battle-tested team ready to go. After you ask these questions, just shut up and listen. How do they make you feel? Do you feel smarter and more confident after talking to them? Or do you feel small and confused? Do they sound excited by the challenge, or burdened by your situation? Your gut feeling here is just as important as their answers. Let me tell you about 2 clients I know. We'll call them the Jacksons and the Garcias. Both were military families, pre-approved for a zero-down VA loan. The Jacksons went with an agent their friend recommended. A nice guy, but he mostly sold million-dollar homes. He submitted 5 offers for them. They lost every single one. He kept telling them, "Your VA loan just can't compete." He made them feel like their benefit was a handicap. The Garcias, on the other hand, interviewed 3 agents who specialized in military relocations. They chose an agent who, during the interview, laid out a 6-point plan for winning with a VA loan. On their very first offer, this agent called the listing agent and sold them not just on the Garcias offer, but on the Garcias themselves, their story, their service. He had their lender call the listing agent too, to personally vouch for their rock-solid pre-approval. They structured the offer to give the seller the exact closing date they needed. They won the house against 2 other offers, one of which was for more money. The difference wasn't the loan. The difference wasn't the market. The difference was the professional they hired to represent them. One treated them like a transaction. The other treated them like a mission. Finding this person is non-negotiable. It is the single biggest factor besides your finances that will determine whether you succeed or fail. Because once you have this A-team in place, your specialist lender and your specialist agent, you're no longer just a person hoping to buy a house. You are a professional operation. You're ready for battle. But even with the perfect team, there's one final hurdle, one last boss you have to defeat before you get the keys. And this final challenge is the one that derails more deals in the last 72 hours than anything else. It's the treacherous, confusing, and terrifying process known as closing. It's a word that sounds so final, so conclusive. But what actually happens behind those closed doors of the title company or attorney's office? Let's pull back the curtain. Closing is essentially the grand finale of your home buying transaction. It's the moment where ownership of the property is officially transferred from the seller to you. All the promises made in the contract are fulfilled. All the money changes hands, and all the legal documents are signed, sealed, and delivered. It's the finish line. But before you even sit down at that table, there is one critical mission you must complete: the final walkthrough. This is usually done 24 to 48 hours before closing. This is not another inspection. This is your last chance to verify that the property is in the exact condition you agreed to buy it in. You're checking to make sure the seller has moved out, that no new damage has occurred since the inspection, like a hole in the wall from a clumsy mover, and that any agreed-upon repairs have actually been completed. You're also making sure that everything that was supposed to stay with the house is still there. The refrigerator, the washer and dryer, the custom window blinds. Do not skip this. I've seen horror stories. Buyers who were so excited to close that they blew off the final walkthrough, only to get their keys, open the door, and find the sellers took the $1,000 smart fridge they explicitly negotiated to keep. Or worse, they discover the basement is flooded because a pipe burst the night before closing. The final walkthrough is your last point of leverage. Once you sign those papers, any problems you discover are officially your problems. Okay, you've done the walkthrough and everything looks good. Now the real paperwork begins. At least 3 business days before your scheduled closing, you will receive the single most important document of this entire process. It's called the Closing Disclosure, or the CD. This document is your financial Bible. It's a 5-page form that itemizes every single dollar involved in your transaction. Your lender is legally required to give you 3 full days to review it. Why? Because in the old days, lenders would slide a document across the table with completely different numbers than what was discussed, and buyers, under pressure, would just sign it. This 3-day rule is your consumer protection, your time to catch any mistakes. And you need to read it. Every line. Compare it to the loan estimate you received when you first applied. Are the numbers the same? Is the interest rate what you were promised? Is the loan term correct? Are there any junk fees that suddenly appeared? But the most important number on this entire document, the one you need to focus on like a hawk, is at the bottom of page 1. It's labeled Cash to Close. This is it. This is the culmination of our entire journey. For a video about buying a home with no down payment, this number is the final report card. It's the exact amount of money you need to bring to the closing table. And right now you might be thinking, wait a minute, if I got a 0 down loan, shouldn't that number be 0? Not necessarily, because a 0 down payment loan is not a 0 cost loan. Your cash to close is made up of 2 things: your down payment, which in your case is 0, and your closing costs. Closing costs are the fees paid to all the third parties who helped make this transaction happen. Think of it like this: you didn't pay a cover charge to get into the club, but you still have to pay for your drinks. So what's in these closing costs? First, you have lender fees. This can include an origination fee for creating the loan, an underwriting fee for vetting your financial life, and points you may have paid to lower your interest rate. Second, you have third-party fees. This is for the appraisal, the credit report, the flood certification, and crucially, the title company services. They conduct a title search to make sure the seller actually has the right to sell you the house, and they provide title insurance to protect you and the lender from any future claims on the property. Third, and this is the one that surprises most first-time buyers, you have what are called prepaids and escrows. You have to prepay for your first year of homeowners insurance. The lender requires this to protect their investment. You also have to prepay a few months of property taxes. The lender collects this upfront and puts it into an escrow account. Then they'll pay your insurance and tax bills for you when they're due, using the money from that account. It's a forced savings account to ensure the most important bills get paid. All of these fees, lender, third-party, and prepaids, add up. Typically, closing costs run about 2 to 5% of the home's purchase price. On a $300,000 home, that could be anywhere from $6,000 to $15,000. And that's the cash you need to close. But remember what we talked about in the negotiation phase? Seller concessions. This is where they become your superpower. If you negotiated for the seller to pay, say, $10,000 of your closing costs, that $10,000 is credited back to you on the closing disclosure, dramatically reducing your cash to close number. If your closing costs are $10,000 and you got a $10,000 seller credit, your cash to close could be very close to 0. This is how you truly buy a house with almost no money out of pocket. It's not just about the loan, it's about the negotiation. So you've reviewed the closing disclosure, the numbers are correct, and you've arranged a cashier's check or wire transfer for your final cash to close amount. The day has arrived. You walk into the office of the title company or closing attorney. You'll be joined by your real estate agent, And sometimes the closing agent is the only other person in the room. The seller might close at a different time. In front of you will be a stack of paper that looks like a novel. It's intimidating. You're going to be signing your name so many times your hand will cramp. You'll sign the promissory note, promising to repay the loan. You'll sign the mortgage or deed of trust, which gives the lender the right to foreclose if you don't pay. You'll sign dozens of other disclosures and affidavits. Here is my most important piece of advice for this moment. Do not be rushed. The closing agent may try to fly through the documents, but you have every right to stop them and ask, "What is this page? What am I signing?" You are the client. You are paying for this service. You need to understand, at least on a basic level, what you are committing to. This is likely the biggest financial decision of your life. Take your time. And then, after the last signature, after your hand is aching and the ink is dry, it happens. The closing agent makes a few calls, confirms the funds have been transferred, and then they slide a small set of keys across the table. That's it. It's over. You did it. You weathered the storm of pre-approval, the emotional roller coaster of house hunting, the strategic chess match of negotiations, the anxiety of inspections and appraisals. You conquered the final boss. You walk out of that office, keys in hand, and you drive to your house. You walk up to the front door. A door you've only ever entered as a guest, as a potential buyer. You put the key in the lock. You turn it. The click of the deadbolt retracting is one of the most satisfying sounds you will ever hear. You push the door open and step inside. The air is different. The silence is different. It's not just a house anymore. It's yours. The journey to homeownership, especially with no down payment, is not for the faint of heart. It's a marathon that tests your patience, your finances, and your nerves. We've shown you that it is absolutely possible. From government-backed powerhouses like VA and USDA loans, to the critical importance of your credit score, to the art of negotiating seller concessions to cover your closing costs. The path exists. The American dream of holding keys to your own home isn't dead. It hasn't vanished. The entry requirements have just changed. And now you know the new rules. You have the playbook. If this video gave you the clarity and the roadmap you've been searching for, do me a favor and hit that subscribe button. Because our mission is to give you the financial tools to build the life you deserve. The question is no longer, is it possible? The only question left is, when will you start? Your journey begins now. Go get those keys.